5 years. That's exactly how long Synthetix has been trapped in this descending structure. If you have been following this channel, you know I do not deal in hope. I deal in probabilities. And right now, the probability of a decisive move, one way or the other, is higher than it has been since 2021. We are sitting at the absolute bottom of the channel. The sentiment is non-existent. The retail crowd has left. But while the price action looks dead, the on-chain reality tells a completely different story. Something massive just went live on the Ethereum Mainnet, and almost nobody is talking about it because they are too busy staring at the 40-cent price tag. Today, we are going to look at why this specific level is your do or die moment for SNX. Welcome back to Crypto Yield Pro. Let's look at the cold, hard data. As of today, Synthetix is trading around 40 cents. We are seeing a complete reset of market interest. If you look at the last 15 weeks of price action, it has been a slow bleed, a classic capitulation grind that is designed to flush out every last weak hand. Most investors look at this chart and see a graveyard. I look at it and see a defined risk setup. We are not chasing green candles here. We are analyzing a project that is trading at all-time lows relative to its fundamental architecture, which has just undergone its most significant upgrade in years. The market is pricing this as if the project is dormant, but the internal data suggests the team is gearing up for a liquidity migration event that could catch the entire market offside. But before we get excited about upside, we have to understand the immediate danger we are in. This is where the narrative shifts. While the price is bleeding, the protocol has effectively de-risked its biggest technical hurdle. I want you to look at the verified data from the last days, because this is what the market is ignoring. First, and most importantly, Synthetix Perps are officially live on the Ethereum Mainnet. This is not a drill. It is currently in a private beta phase, invite only, which is why you have not seen a sudden explosion in volume yet. They are guarding the launch to ensure stability, but the infrastructure is there. This signals a massive pivot away from the pure Layer 2 narrative back to capturing the deep liquidity on Layer 1. Second, on January 20th, they deployed a feature called chase orders. Now, to the average retail investor, this sounds boring. To a sophisticated trader, this is everything. It allows you to lodge a limit order that automatically adjusts to the best bid or ask. This is the kind of tooling you see on high-frequency terminal software, not decentralized exchanges. They are building a user experience that rivals Binance or Bybit, and they are doing it on-chain. Third, the distribution network is expanding. We have confirmation that Infinex, the new aggregation layer, is integrating Synthetix as a primary liquidity source. This means Synthetix does not need to rely solely on its own front end to get volume. They are becoming the back-end liquidity engine for consumer-facing apps. And finally, look at the incentives. This is the yield part of our thesis. Right now, if you hold SNX on a centralized exchange like Binance or Bybit, you are earning maybe 0.8%. If you move that capital on-chain to the mainnet pools, the yield is pushing over 6%. That is a massive spread. It creates a natural economic force for capital to leave exchanges and lock into the protocol. The governance has also just passed Proposal SR2, explicitly stating their focus is to avoid disrupting the critically important launch. The entire organization is aligned on this one event. Now, let's let the chart speak. Here's SNX on the weekly timeframe. This is the only chart that matters right now. We are respecting a descending channel that dates back to the 2021 top. It is precise. Every time we hit the top rail, we reject. Every time we hit the bottom rail, we bounce. We are currently sitting right on that bottom support rail between 35 and 40 cents. Look at the exponential moving averages. Price is currently below the 10, 21, 55, 100, and 200 weekly moving averages. This is objectively bearish momentum. There's no sugarcoating that. The trend is down. However, the distance between the price and these moving averages is stretched. We call this extension. When price gets this far away from the mean, it often snaps back like a rubber band to reconnect with the trend. The Heikin-Ashi RSI has crossed neutral to the downside and is approaching oversold territory. This usually precedes a volatility expansion.
Here's my strategy, and this is exactly what I'm doing with my own capital. I have defined a load zone in the green box between 35 and 50 cents. This is where the risk-to-reward ratio is mathematically superior. My invalidation level, the point where I admit I'm wrong, is a weekly candle close below 30 cents. If we lose the 30-cent level, it confirms a breakdown of this 5-year channel, and the next technical support is all the way down at 17 cents. That is the 1618 Fibonacci extension. I will not hold through that drop. I use a hard stop. However, if this channel holds, as it has for 5 years, our upside targets are clear. The first major resistance is at 90 cents, which is the 236 fib level. If we reclaim that, the next targets are $1.20, $1.70, and then the top of the channel at $2.50. Remember, we touched $2.50 back in October, and while we were rejected, that move proved the channel is valid. A move from 40 cents back to the top of the range is a 300% return. That is why we take the risk at support. So, what is the game plan? We are placing a bet on the convergence of a technical bounce and a fundamental launch. My bull case: the private beta on Mainnet opens to the public in February. Volume spikes. The yield spread forces supply off exchanges. Price reclaims the 10-week moving average and grinds toward 90 cents. My bear case: the beta is prolonged. Users get bored. The general market corrects, and SNX loses the channel support at 35 cents. In that scenario, we get stopped out, we preserve our capital, and we look to re-enter at 17 cents. This is not about being right, it is about being positioned. I'm accumulating here because the asymmetry favors the upside, but I'm protecting my downside with a strict stop loss. Back in October, I closed a trade for over 100% gain using this exact setup, and now I'm looking to repeat that performance. Synthetix is at a crossroads. The tech is live, the team is shipping, but the price is lagging. These are the moments where the hardest trades are often the most profitable. But you must have discipline. Do not marry your bags. Respect the stop loss. I'm watching that private beta status daily. The moment that tag is removed, we could see the repricing event we have been waiting for. Now, please destroy the like and subscribe buttons to show your love and appreciation for me being here every single day. If you want to track these levels in real time with me, I post my daily chart updates and specific DeFi alerts in my free Telegram group. The link is in the pinned comment below. And if you want to see exactly how I traded this channel perfectly in 2025 to secure over 100% profit I mentioned, you need to watch my previous 2 videos on Synthetix right here. It breaks down the accumulation logic that we are using again today. Disclaimer: this is not financial advice, just my personal journal. Trade safe, and I will see you in the next one.